What's going on, everyone? Welcome to another week's lecture, and this week we're talking about compound interest. So this week we're going to be talking about how you can use it to actually grow your investments over time and how it actually makes it exponentially larger if you're adding monthly to the amounts you're investing. And we'll take a look at some other aspects of compound interest that make it very useful, including the rule of 72 that we talked about in this week's podcast, and how you can exactly how big it can get if you actually do this right. So hope you enjoy this one, and I'll see you guys next week. Hey everyone, welcome back to another great week of lecture, and this week we're talking about compounding interest, and this is a big topic. Compound interest is very useful and commonly utilized in a lot of aspects of both economics and finance. Essentially, it's the idea that anyone can actually earn interest on interest that was accrued in a prior period of an investment's lifetime. So this interest isn't just earned and taken home. You can actually earn more in interest on it. The new interest actually compounds, as it's called, on the already accrued interest. Since compounding grows as interest gets larger, and this interest is then used to yield an even larger interest payment, the growth in the investment is exponential over longer time horizons. And this is what makes it a great investment opportunity. If given the proper amount of time to compound, exponential growth can make you immensely wealthy at the age of retirement. So let's talk about compounding frequency, and this is important as well. So in order to understand compound interest, we first need to understand how the frequency of compounding aspect works. It is essentially how often per year interest is compounded and paid out to the investor. This can be yearly, semi-annually or twice a year, monthly, daily, or even continuously compounded. Some investments, like zero coupon bonds as they're called, they don't have a compounding frequency at all, but they actually pay the interest out fully at maturity. Now, the effectiveness of compounding relies on two main factors. The first is the frequency of compounding, as we're discussing right now, and the second is the interest rate prevailing in the economy. The more frequently compounding occurs, the higher the return on your investment. This return is that interest that's actually paid out to you. Now let's take a look at an example to get a better grasp of this. So an investment that pays 0.5% interest monthly or 6% yearly, and we want to know which is a better investment. So how do we do this? I can actually use a simple formula here that we're going to talk about, and we can do monthly compounding here, and we yield 6.167% by compounding more frequently, or monthly to be exact. So we choose monthly compounding in this case, if given the option. And from this example, it's clear that the more frequently compounding occurs, the larger our investment becomes over time. And of course, it's worth noting that the larger the interest rate, the more noticeable the difference in compounding frequencies. And this increases as interest rates increase. Let's take a moment to take a look at something that's quite common in financing, and especially with larger ticket items. This is called the annual percentage rate, or APR. And you might hear this as APR financing, among other things. And this APR term is often used to intrigue people by using their 0% APR financing. But all it is simply the annualized interest rate of accrued interest. So it's just the annual interest rate and the interest accrued over that year that's payable at the end of the year during the duration of the loan, divided by the loan's principal amount. So it's essentially the interest rate that you're paying on the loan. But the sneaky part about this is that these rates are often compounded either daily or monthly, not annually. So it's actually costing you more than you might think. 0% APR is also used for marketing purposes. And you should be skeptical when you see this, because there's often fees hidden in other places that you might not expect. So don't be fooled by the marketing. Now we can take a look at how we calculate compounding interest, and we'll start this off by looking at an example. So historically, the stock market, and more specifically the S&P 500 index, which is an index of the 500 largest companies in the United States, has returned on average 10.49% since 1926, or roughly 100 years. Now it's important we adjust this for inflation, and that brings us to about 7% per year, so this is what we'll be using. So if you were to purchase shares of the S&P 500 index fund, SPY is a ticker, for example, that you can purchase, you can compound this 7% interest over as many years as you want. So on average, 7% is average, remember, so some years will be excellent and others won't be as great. You'll even have negative returns, but 7% is average. We get the following compounding effect. So if you were to deposit and invest $1,000 into the index fund, you will on average earn $70 in interest over the first year, which is the $1,000, and 7% earned on that, which is $70. The beauty of this, however, starts in year 2. So now we have $1,070 accrued, and the earned interest is treated like the actual principal with compounding interest. So therefore we earn 7% on $1,070 instead of $1,000, and we earn $74.90 in year 2 and finish with $1144.90 in your pocket. Now if this is done for many years, it'll snowball into quite a sizable sum of money, and especially true if you dollar cost average, which is adding money consistently over a period of time. In this way, interest accrues interest on itself, which is in itself compound interest. So when we dollar cost average, again using this big word, when it's utilized, it actually acts as if the principal compounds more often, because we add a set amount monthly and forget about it. Compounding also goes a bit further, and there's something called continuous compounding and compound earnings that we should be aware of. When it comes to empirical applications, such as in the academic space, like the pricing of derivatives like options or futures, it's usually done through the use of a model, and these models are things like the Black-Scholes-Merton model or BSM model, or binomial trees, which are often used to price options and futures. These utilize what's called continuous compounding, and this is a very interesting thing as well. Continuous compounding utilizes a relatively simple first-year university calculus component called a limit. And if you're not familiar with this, don't worry about it. I'm just explaining how it works. So if we take the limit as the compounding frequency goes to infinity, or the period of frequency of compounding converges to 0, we get that continuous compounding is exponential in nature and converges to the natural logarithm of e. And this is really interesting because, of course, it's exponential growth, right? So if this sounds complicated, don't worry. All it means is that compounding, if happening frequently and almost continuously, yields exponential growth of the principal over time. Pricing models utilize it to omit ugly formulas, and the rounding is not too much different most of the time from annual compounding, so it's used as a placeholder. In practice, and particularly in finance, mutual fund, stock, and bond growth is classified oftentimes as compound earnings instead of compound interest. This is because the dividend compounding and the appreciation of the asset are also included in this. So therefore, compound earnings varies from compound interest in that it captures all aspects of the asset that are compounding, not just the interest on it. And these include that dividend interest earned as well, and the appreciation of it. And now finally, we can take a look at something called simple interest, and this is the opposite of compound interest. So this is another important distinction that we need to make here. As we know, compound interest is interest earned on both the principal and the interest already accrued, whereas simple interest pays out interest to the investor but only keeps collecting interest on only the principal amount, not the interest accrued before. A good example is interest-paying bonds. These are also called coupon bonds, where interest is called a coupon payment. These bonds don't compound the interest they pay and is therefore simple interest paid usually biannually for these types of bonds, which means it's paid every 6 months. Essentially, simple interest is interest that doesn't collect any interest, which is interesting, right? Huh. Except on the principal. As you can easily do online with a compound interest calculator, the difference in the size of your investment is enormous given a longer time horizon. So this is interesting when you compare simple to compound interest. So let's do that now as an exercise. Without even including the notion of adding money each month, or dollar cost averaging, let's see the difference between simple and compound interest over a 30-year horizon or 30-year time period. So let's start with simple interest. We have $10,000 as our initial investment. We earn 7% as usual, and we have 30 years as the time horizon. So we earn 7% or $700 per year for 30 years. This is $21,000 in interest and the principal, which is $31,000. But this is where it gets crazy when we look at compound interest. So the exact same setup here, I've copied and pasted it, but we earn $700 in year one. But then the total comes to $10,000 plus that compounding, which is $76,122.55. Which is almost, well, it's more than double, my mistake, more than double the simple interest. And keep in mind, if you add the $200 a month, for example, the compound will be a whopping $310,013.07. This is why it's the eighth wonder of the world. I'll see you guys next week.